Now I realize that we're throwing a lot of terms at you and sector specific and industry specific jargon. The idea really is just to kind of get a grasp of the concepts, but more the focus of these examples is just to get a feel for what we're looking at that time, at that specific time in the market. This isn't any kind of course, forecast of what's going to happen in the future. So if you're looking at this CD 2 or 3 years after it was made, naturally the market environment is going to be completely different from what it is today. And the idea is just to reflect upon what the information and news is doing and what kind of impact it's having on the market. So as we continue on here, we have another example of the Euro US dollar, and really it's an environment where there's just interest rate rumors and signals. There's talk by the Fed, there's talk by the European Central Bank as to what they're going to do with interest rates, and so the market's just trying to price in the interest rate differential between the two regions. So here on this specific day, we had an interest rate announcement by the Fed, and the forecast was for rates to be hiked by 1/4% to 4.25%, and the actual interest rate came out at 4.25%. Now, the Federal Reserve Chairman Alan Greenspan, of course, the announcement comes from the FOMC, the Federal Open Market Committee, and it consists of 7 governors of the Federal Reserve Board and 5 Federal Reserve Bank presidents. The FOMC, they meet about 8 times a year in order to determine the near-term direction of monetary policy and discuss really any changes in monetary policy, and they announce it immediately after the FOMC meetings. The Federal Reserve, as expected on this particular day, they raised the overnight bank lending rate 25 basis points to 4.25%. But more importantly, policymakers really also offered light at the end of the tunnel. And when they released their minutes, they craft the verbiage of the minutes in such a way that one of the objectives is to temper the market response. So they have to be very careful into how they express what their intent is for the future. So recently they've been using this word accommodative or accommodation, and in this particular case, rather than using the word accommodation, they've really changed the word to some further, quote unquote, policy firming is needed. And so the market kind of just responds accordingly to what the new verbiage implies. So the statement really will mark an end to the regular expectations of 25-point basis hikes, and now cast some doubt into the market as to what to expect in the future. When we look at this chart, we actually are seeing this modest fall in the US dollar, or a rally in the euro. And at this particular point, for example, the ECB members, the European Central Bank members, actually are starting to express the possibility in increasing interest rates, of course depending upon the data support or the state of the economy and what the data suggests about the state of the economy. We go into this sideways movement, so the market prices in the expectation of potential for the ECB raising rates, the US maybe slowing down rate hikes, and of course in anticipation of this announcement here that the Fed will only raise rate by 25 basis points rather than raising it by more, the market actually begins to price it in. Also, the Fed has been changing their language about the interest rate hikes, so the US dollar takes a fall during this period in anticipation of the FOMC minutes. And this is when the announcement was actually made, and we can see here that there was really very little reaction or inconsequential reaction because the expectation was priced in and it met expectations. This is just some dialogue of the overview of what has been happening at the time, and the ECB and members are open about the potential for a Eurozone rate hike. They threw in a disclaimer stating that it was, of course, data dependent. Several days later, the Fed starts talking about slowing rate hikes, which is a change of language for them. And it's really an opposite of what happened last year when the US dollar was at all-time lows before giving up. Partly as a result, the Federal Reserve was signaling it was going to be more aggressive about raising rates. And the ECB here continued its rhetoric and was expected to cut interest rates. So really we're looking at the interest rate differentials that can determine the swings and the changes of the cross rate valuations.